The truth is brutally simple, yet it escapes the vast majority of traders for years. If you do not learn to think like the entities that actually move price, the market makers, the large institutions, the smart money, you will continue to lose money to them without ever realizing you are the prey. Most retail traders live inside a comfortable illusion. They believe they are competing on a fair battlefield against thousands of other small participants just like themselves, other beginners with $500 accounts, other people staring at the same TradingView chart. They genuinely think the game is level. It is not. It never has been. Before we continue, make this commitment. This channel isn't about quick fixes, it's about developing traders with mental strength and discipline. If that resonates with you, join us. Subscribe now so you don't miss any of our upcoming videos. Stay until the end and keep progressing with us, one mindset shift at a time. This video isn't just another trading video, it's a mirror for your mindset. Like now, comment what resonates, and stay until the end. Because one idea here could change how you think, and how you trade. Let's go. Behind the curtain stand giants, banks, hedge funds, proprietary trading firms, and specialized market-making entities whose sole job is to provide liquidity while extracting profit from everyone else. These are the players who create the very liquidity they later consume. These are the players who decide, with surgical precision, when a support will hold and when it will be violated by exactly 3 ticks just to raid stops. These are the players who write the unspoken rulebook that every new retail trader walks into blind, convinced they have discovered a secret strategy that will finally make them rich. Here is the painful core reality this chapter forces you to confront. The entire architecture of modern financial markets is deliberately structured so that retail traders, almost by default, become the primary liquidity providers for institutional order flow. Every single time a retail trader clicks buy, there is a sophisticated counterparty happily selling to him at that exact moment. Every single time a retail trader clicks sell, there is a sophisticated counterparty quietly buying from him. The market makers do not guess where the orders are. They know. They see the aggregated order book. They see the clusters of stop losses resting just beyond obvious swing highs and lows. They see the pending limit orders stacked like firewood around round numbers and psychological levels. They see the heat map of retail positioning in real time. Their objective is never randomness. Their objective is efficiency, move price to the exact zones where the greatest amount of trapped capital sits, harvest that capital, and then allow, or engineer, the move in the direction that serves their much larger positions. They are not trying to outpredict the market. They are engineering the market. They are the house, and retail traders are the players who keep walking up to the table believing they can beat the house with a system. If you have ever watched price reverse the instant you entered a trade. If you have ever had your stop loss taken out by a wicked spike that lasted exactly 5 seconds before price rocketed in your original direction. If you have ever seen a breakout fail spectacularly only for the real trend to begin after you were already shaken out, then you have not been unlucky. You have been perfectly predictable. And predictability, in this game, is the deadliest sin. Market makers possess an almost terrifying understanding of mass retail psychology. They know that when price surges upward in a straight line, the average beginner's brain screams, "I'm missing out," and chases. They know that when price collapses vertically, the average beginner's amygdala fires, "Get me out," and panic sells. They know exactly where the herd places stops, just below the previous low, just above the previous high, or exactly at the 1-to-2 risk-reward ratio taught in every YouTube video. They know the patterns retail traders love: double bottoms, head and shoulders, flags, triangles, moving average crossovers, RSI Divergences. They know because they helped popularize those patterns decades ago. Precisely so millions of traders would use them and become readable. To truly grasp their playbook, you must first internalize one foundational concept: price cannot move meaningfully without liquidity. Large directional moves require an opposing force, someone willing to take the other side in size. Market makers do not create liquidity out of thin air. They induce it. They manufacture the conditions under which retail traders willingly hand over their orders. They push price into regions where stops cluster, where limit orders accumulate, where emotions peak. These regions are not random. They are pools of fuel waiting to be ignited. The moment price penetrates those pools, a cascade begins, stops trigger, creating market orders, pending orders fill, adding momentum, fear and greed amplify the move. A massive candle appears on your chart and you think, the market is breaking. In most cases, the market is not breaking anything except retail accounts. It is raiding liquidity, filling institutional tickets, and preparing the ground for the real directional move that will now occur with far less resistance. This is the oldest and most reliable trick in their arsenal: trap the maximum number of retail participants on the wrong side of the market, harvest their liquidity, then reverse price into the direction originally intended all along. The move that feels like the birth of a new trend to the retail crowd is, in reality, often the final liquidation phase. Before the genuine trend can run cleanly. Key levels, previous highs, previous lows, round numbers, trend lines, are not respected because they possess mystical significance. They are respected because they are obvious. And obvious means crowded. And crowded means profitable to raid. Market makers do not fight liquidity. They seek it, trigger it, consume it, and only then do they allow price to travel efficiently. Consider a textbook scenario that plays out literally thousands of times every single day across Forex, indices, commodities, and crypto. Price has been in a clear downtrend for hours or days. It finally reaches a significant higher timeframe support zone and prints what looks like a perfect double bottom with strong bullish engulfing candles. The average retail trader's eyes light up. Reversal time. They buy aggressively, often moving their stop loss just below the freshly printed low because that's where everyone else will have theirs. The trade feels perfect. It feels safe. It feels smart. What happens next is almost scripted. Price drifts lower, slowly at first, then with increasing speed, until it violates that freshly printed low by a handful of ticks. Stops cascade. Panic sets in. The trader who was certain the bottom was in now watches their account bleed red and either get stopped out or closes manually in disgust, convinced the downtrend is still in control. The moment the last weak hand capitulates, price reverses violently upward, often in a single candle that erases the entire stop run and launches into new highs. The trader who was just stopped out stares at the screen in rage, muttering that the market is rigged, that they are out to get him personally. He is not wrong about being targeted. He is simply wrong about the they. It is not personal. It is statistical. He behaved exactly like 87% of retail traders in that situation, and that was enough. Emotional entry equals predictable entry. Standard stop placement equals visible stop placement. FOMO chasing equals guaranteed late entry. Market makers hunt these behavioral signatures the way a cheetah hunts the slowest gazelle. They do not need to know your name. They only need to know how the average gazelle runs. To escape this cycle, you must forcibly shift your perspective from that of a retail trader trying to predict price to that of an institutional player engineering price. Stop asking, where is price going next? Start asking, whose orders are being filled right now, and who benefits from this move? Every spike, every wick, every sudden reversal is no longer noise. It is evidence. It is communication. Someone, somewhere, just accumulated or distributed millions, or billions, of dollars worth of exposure. Because you and thousands like you reacted exactly as expected. Stop-loss orders are the most delicious treasure chests in the market maker's world. They are guaranteed, executable liquidity at a known price. If a critical mass of retail traders is long with stops clustered just below a swing low, any institution wanting to establish a large long position knows exactly where to drive price, down into that cluster. The resulting cascade of stop-triggered sell orders becomes the very buying opportunity the institution was waiting for. Once the stops are consumed, resistance evaporates, and price can rocket higher with almost no opposition. The same mechanism works in reverse for short accumulation. Fake breakouts are another masterpiece of psychological warfare. Retail traders adore breakouts because they are clean, dramatic, and emotionally satisfying. When price approaches a major resistance, anticipation builds. Traders place buy-stop orders just above the level, ready to ride the big move. Market makers see those orders like glowing beacons. They gently nudge price above the level, just far enough to trigger the buy stops, welcome the flood of retail longs, then reverse price sharply lower, rating the newly activated stops below the former resistance, now turn support. Only after this double liquidation, trapping breakout buyers and shaking out anyone who was short, does the real breakout often occur, now on vastly reduced resistance because the crowd has been cleaned out twice. The deeper you descend into the playbook, the clearer it becomes that raw price movement is secondary. The primary weapon is emotion. Every candle is a psychological operation. Every range, every spike, every period of painful sideways action is designed to cultivate specific emotional states: hope, fear, boredom, overconfidence, despair. When enough traders occupy the desired emotional state, their collective behavior becomes exploitable with mathematical certainty. Consider a slow, grinding uptrend with shallow pullbacks and higher highs/higher lows. Structure looks pristine. Retail confidence grows. Traders add to winners. They move stops to break even because the trend is your friend. Then, without warning, a violent downward wick appears, often on low-volume overnight sessions or around news, shattering structure and triggering widespread panic. Positions are dumped. Stops are hit. Some traders flip short, convinced the trend has ended. The moment capitulation peaks, price stabilizes and resumes climbing, often faster than before because the weak hands have been purged. This is not chaos. This is choreography. Order is created to breed complacency, then disorder is weaponized to harvest liquidity at maximum emotional pain. Imbalances, also called fair value gaps, are another favorite tool. When institutions execute large directional orders, they often leave zones on the chart where very little trading occurred, gaps or areas of low volume. Price tends to return to these zones later to fill the inefficiency before continuing. Retail traders see the initial explosive move and chase it, believing momentum is unstoppable. By the time they are fully positioned, price reverses to fill the imbalance, stopping them out. Once the Inefficiency is resolved, the original direction resumes, now with the retail crowd watching from the sidelines, bitter and undercapitalized. Time itself is weaponized. Prolonged consolidation is not neutral. It is psychological torture. Traders hate waiting. They hate boredom more than they hate losing. Hours, or days, of tight sideways action erode discipline. Traders begin anticipating breakouts that have not yet happened. They place orders early, to get a good price. Market makers collect those premature positions like a fisherman reeling in a net. When the actual expansion finally arrives, it is frequently a fake-out designed to trigger the premature entries before reversing. Only after the second or third false start does the true directional move unfold. Even fundamental news is subordinated to this framework. Major economic releases do not dictate direction. They provide cover and volatility for pre-planned liquidity grabs. Hours before a non-farm payroll or central bank decision, you will often see price deliberately swept into key levels on both sides, rating buy stops above resistance and sell stops below support. When the headline hits, the initial spike is almost always a stop run in disguise. The real trend emerges only after both sides of retail positioning have been liquidated. Everything, absolutely everything, revolves around liquidity. The market is a giant heat-seeking missile program to fly toward the densest clusters of orders and explode them for fuel. Obvious support and resistance levels are not respected because they are strong. They are rated because they are crowded. The moment you internalize this, your relationship with the chart changes permanently. You stop fearing stop hunts. You start expecting them. You stop chasing clean structure. You start reading intention. You stop reacting to dramatic candles. You start asking who just got filled. You stop treating volatility as noise. You start treating it as evidence. Engineered volatility, stacking of multiple traps, prolonged ranges designed to exhaust patience, sudden spikes that seem to come from nowhere. These are not anomalies. They are the standard operating procedure of entities that must move billions without leaving fingerprints. The moment of true awakening arrives quietly. One day you are watching a vicious stop run and instead of feeling anger, you feel recognition. Instead of cursing the market, you whisper, "There it is. They just took the lows. Now we go." And price does exactly that. That is the moment you stop trading like prey and begin trading like someone who finally learned the language being spoken in every wick, every range, every moment of silence before the storm. The market maker is not hiding. Their footprints are everywhere, in the equal highs that get swept, in the equal lows that get rated, in the news spikes that take out both sides, in the painful consolidations that make traders overtrade. Once you learn to read those footprints, the illusions dissolve. You no longer take moves at face value. You no longer hand over your liquidity willingly. You wait. You watch the trap spring on someone else. And only when the dust settles and the crowd has been harvested do you step in, calm, disciplined, aligned with the only players who actually matter. That is the real edge. Not a faster indicator. Not a secret pattern. Simply the refusal to behave like the crowd the market was built to exploit.